Yep, all good.
Good morning. Welcome to AmericaFirst Wealth Management Investment Outlook for Monday, October 28th, 2024. My name is Dan Liu. I'm the Chief Investment Officer at AmericaFirst Wealth Management. And joining me today once again is Michael Cheah, Head of Fixed Income and Portfolio Manager. Next slide, Mike. It's just a standard disclaimer. We're not making any investment recommendations here. We're just giving our investment outlook. Our opinions are subject to change as markets and information changes. Next slide, Mike. What we like to do every week is start off with our conclusions and outlook first, and then provide supporting detail. So in terms of my market outlook, very interesting week. Late Friday, Israel retaliated and attacked Iran. And while the attacks seem initially focused on military targets, namely weapons manufacturing and radar facilities, any further escalation may trigger a flight to safety and volatility in energy prices. We're waiting to see what the market's futures look like Sunday evening and see how the markets open on Monday. Donald Trump extended his lead among the betting markets, and I'll point out some data there. Earnings report overall last week we felt were good, but the rally in financial stocks faded as companies were giving lackluster outlooks, and investors are seemingly cautious. As we clearly had a pullback in the markets, and also interest rates backed up. This week, 5 of the 7 Magnificent Seven stocks report, and a lot of S&P 500 companies are reporting, 168 this week. So a very busy week in terms of the earnings front. Pretty interesting point we want to point out is gold is no longer trading inverse to the dollar. In the past, gold would do the opposite of what the dollar was doing relative to other currencies, but now it looks like the dollar is going up and gold is also going up. Also this week, a lot of key macro data points. Tuesday, we got the JOLTS job openings. Wednesday will be GDP. Thursday will be core PCE, personal income and personal spending. Friday will be non-farm payrolls, unemployment, and ISM manufacturing PMI. So certainly a week full of a lot of data, from company specific to macro data, and certainly we're worried about what's happening over in the Middle East as well. And we're in the final home stretch for the U.S. candidates Trump and Harris, and we'll be watching for any remaining information there. Next slide, Mike. It was certainly a crazy weekend, as I highlighted the Israel attacks. And also in terms of presidential candidates, a lot of activity. Trump appeared on the Joe Rogan podcast for almost 3 hours. Harris appeared in Houston with Willie Nelson and Beyonce. Harris only spoke for about 5 minutes. Also interesting news, Washington Post and the LA Times, for the first time in a long time, are not endorsing any presidential candidate. And specifically for the Washington Post, it's the first time since 1980 that they had not endorsed the candidate. And interestingly, as many of you know, Jeff Bezos owns Washington Post, and the rumor is that he's told the editorial board not to endorse a candidate. So that's kind of interesting. Also interesting is multi-billionaire Warren Buffett is not endorsing a candidate. So that's kind of interesting. New York Post obviously endorsed Trump. And another surprise this weekend was major Muslim and Arab leaders in Michigan endorsed Trump. And as you know, Michigan is a key swing state. Next slide, Mike. In terms of the betting markets, this is poly markets. Last week, we showed that Trump was leading Kamala Harris by 60 to 39%. And as of Saturday, the 26th, Trump is now just under 65% betting odds versus Kamala Harris, a little tad over 35%. So significant upswing in Trump's betting odds here. Next slide, Mike. Turning to key market stats, the major equity markets were a little bit mixed. The Dow Jones Industrial Average was down 2.68 for the week. S&P 500 was down just under 1%. NASDAQ names fared better with the NASDAQ Composite and NASDAQ 100 up slightly. Small stocks were down 2.93%. And the style indices, large growth was just down 1 basis point, roughly flat. Value stocks were down. International stocks were down for the week. And as I mentioned, interest rates backed up and the iShares Core Aggregate Bond Index was down just under 1%. So a volatile week. And as we indicated on our previous weeks, we're expecting a lot more volatility here, so we're certainly seeing it. But longer term, we still remain bullish. Next slide, Mike. S&P 500, technically, it shifted to a negative indicator. We fell below the 10-day moving average, and you also see the RSI, Relative Strength Index, starting to go down. So when we see that pivot down, breaking below the 10-day moving average and the RSI going down, technically to us, that's a sign of a weaker market in the near term. Next slide, Mike. The 10-year Treasury yield backed up 17 basis points for the week, ending the week at 4.25%, and now is up 37 basis points year to date. And technically, we're 10-year yield looks like it's continuing to climb and is above its 10-day moving average. Next slide, Mike. Looking at the yield curve shift from the end of September and then the last 2 weeks, you clearly see that the yield curve has risen pretty much across all maturities from about 1 year and out. So we're seeing the yield curve starting to shift up. I'm sure Mike will talk more about that. Next slide, Mike. And as I mentioned, this is a chart of gold versus the DXY dollar index. And you can clearly see in the near term, gold is rising. And in the past, it was trading inverse to the direction of the dollar. So something is clearly happening that's causing this dislocation versus historical correlation. So Mike is going to talk quite a bit more on gold later, so I won't steal his thunder. And we're turning it over to Mike's section here.
Thanks, Dan. You want to talk about
one more?
Yeah.
Yeah, one more I forgot to mention. Another billionaire, we like to track what the billionaires are doing. Paul Tudor Jones is a multi-billionaire hedge fund manager, and he stated that he's long gold and Bitcoin, and he believes that all roads lead to inflation. And this is consistent with what I believe we mentioned last week, regardless of who wins the election. We don't see their fiscal policies leading to lower inflation in the immediate future. I mean, both candidates will promise everything, but we don't see any tangible evidence that their actions will actually decrease inflation in the near term. So Paul Tudor Jones is long gold and Bitcoin, and the gold chart suggests that there's more inflation ahead. Next slide, Mike. Turning it over to you.
Okay, thanks, Dan. All right, so zooming out of the U.S., look at the global economy. In general, the global economy is extremely strong, and we are also seeing that the debt situation is rising across many countries. So when I look at this and strong economy suggesting that inflation is not out of the way, at the same time, countries are borrowing a lot of money. This is not a time to be complacent. This is a time to be worried, right? And this is, I think, reflected in the rally in the gold market. telling us that they're worried. This is a flight to quality. They're worried about historically when gold goes up, it reflects a fear that inflation may go up again. And this is also supporting the notion why the interest rates have been moving up so sharply recently. When we look at the economy, right, we see that the beige book, right, has been hanging around the zero line, and previously, when the Fed cut rate, they cut rate when the beige book is into a recession below zero, meaning the economy is contracting, 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 contracting. But here, I'm still puzzled with uh, why the Fed took the risk to cut rate when the economy is not yet in a recession. And this is a very troubling chart that is going to future historians are going to look back at this and say this all doesn't make sense because the GDP is growing above potential. And at the same time, inflation has turned down because usually when we have growth stronger than potential, inflation tends to move up. So perhaps the Fed was focusing too closely on this and not so much on the growth being too strong. Well, after the Fed has cut rate by 50 basis, it's not surprising that a lot of the economists that are surveyed by the Bloomberg collectively, they have raised projection for the U.S. economic growth and raised and reduced the year-end year-ahead recession odds to only 25%. It's the lowest reading since March 2022. So as you can see, the black histogram here for the in the October survey for third quarter as strong as 2.5, and quarter four, quarter one have all also been revised upward. So no recession, right? Further down the road, we might have a recession. We might have a recession because many provisions are set to expire in 2025. If the Tax Cut and Job Act extensions are unpassed, individual tax rates would revert 1 to 4% higher to pre-2018 levels. The small business tax deduction would end and the individual tax deduction would fall. So this could represent the largest tax hike in history, right? So, well, this could create a recession, right? Companies may fire workers, consumer may spend less because both sides are seeing higher taxes. When it comes to inflation, people are now reverting to the idea that perhaps Jay Powell has messed up and he could be recorded as the second Arthur Burns. And back in the 70s, Arthur Burns cut rate too soon when inflation was coming down, but the economy was still growing faster than potential GDP, just like what we have here. Subsequently, the rate cut strengthened the economy further and inflation made a U-turn. And the rest is history. Paul Volcker came in and brought rate to incredible levels, and we all suffered just because Arthur Burns cut rate too early.
Hey, Mike, go back to that chart.
Yeah.
U.S. ditches Bretton Woods gold standard.
Yeah.
You think that there might be any action on gold again if gold continues to rise?
When I look at the market, right, I'm always like scared, right? Always scared because Warren Buffett told us that there are many ways to lose money. Our job is to say no, 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 and in my case, I'll say hell no, right? So what I'm seeing is that I'm always concerned with a crash somewhere, right? And I always think about where are the sellers coming from? Sellers are often the previous buyers, right? So this time around, gold, could gold come off? Well, depends on who are the sellers. Who are the sellers? The current buyers. The current buyers are central banks, right? They're central
Mm-hmm.
banks, and according to the Economist magazine that came out this week, central banks collectively are holding only 9% of their reserve in gold. This is the average of all the Western and the emerging market countries, 9%, right?
Mm-hmm.
And one of the country has stated categorically that they are targeting for 20%. And with 9%, these buyers of gold, are they going to sell? No, this is a political decision. They are not selling to take profit. And if the market were to drop, they're not selling to cut loss. They may buy more.
Mm-hmm.
So, I think that the gold has a momentum of its own, and what could be our new OPEC embargo, right? Would be the possibility that the BRICS country, as advocated by Putin in this week's meeting, they want to accelerate the
Mm-hmm.
departure away from the dollar as the trade settlement currency, right? And they are proposing something called a unit. The unit would be backed by about half by gold and the rest by currencies of the major BRIC members.
Mm-hmm.
So if they could pull that off, then we have our own version of the OPEC embargo.
Mm-hmm.
Dollar would weaken sharply, and we'll get imported inflation. That is my current scenario at the moment.
Mm-hmm. Well, it'll be interesting to watch. You
Yeah.
and I both know that in the long history of markets, whenever there's a crisis and one asset valuation goes too high or too low, governments will change the rules of the game.
Yes.
So,
Yes. Yes.
and
Yes.
I, there's one thing we can't expect if we have another crisis situation, the rules again will be changed. So,
Yeah.
uh,
There's a book that came out a few years back called Currency War, right?
yes, yes, I have it.
Yeah. I think this might be the new reserve currency war,
Hmm.
where the world is going to be polarized, okay, right, into the old world and the BRICS.
Hmm.
And already I'm reading that Malaysia and Indonesia are going to be signed in as a new member of the BRIC plus plus.
Mm.
Yes, so all extremely interesting, extremely interesting. So it's our job. It's our job to pay attention to all these things that are not on television, so that we can position our portfolio, and hopefully, the people who are watching our video podcast, could also think in a similar manner and see things from a different perspective.
All right.
Mm.
Very, very good insights, Mike. And
You're
thanks for
welcome.
keeping an eye
Yeah.
on what's happening around the world. Okay.
Moving on to monetary policy, right? Um, this is kind of a very sad chart, because if you look at the actual and the FOMC projection, right, uh, they have not been accurate. Okay, they have not been accurate. Okay, and this is the actual for real GDP, and this is the FOMC projection for real GDP. Right? They've been expecting the economy to weaken, to weaken, to weaken, to weaken. No, economy is going up. So something like this is extremely interesting, because here you have the pilot of our economy, right? Okay, they're flying us to where we are going in the plane, right? But the GPS, okay, is broken. Okay, right? Okay. So how does this make me feel comfortable, right? with this kind of projection and their action, right?
Mm.
So I think it's humbling. I think it's humbling that even the Federal Reserve, the people charged with the power to set monetary policy, get it wrong. Okay,
Mm.
the frightening part is that they are determining policy that affect all of us. Right?
Yeah. You're basically saying that the Fed sucks at forecasting. Why should they be
Right.
implementing policy? Okay.
Yeah. So, so the next time you go into an Uber car, just make sure that the GPS is working, right? Otherwise, you have no idea where you end up.
Right.
Okay.
Okay.
Yeah.
All right.
And this is also very troublesome because this is the beige book that the Fed were looking at in their October meeting, right, when they decided on the giant 50 basis cut. If you look at it, right, they are not concerned about slowdown recession. They are not concerned about credit lending. They're not concerned about inflation. They're not concerned about supply chain problem. And the election is a small little blip, right? Okay, so so given all the decline in concerns, why cut? Especially when, to the extent that they're worried about election, right, which is a major known unknown, right? It's a major known unknown. Why take the risk with a jumbo cut, right? This whole thing doesn't make sense. This whole thing doesn't make sense. I hope that Jay Power would write a book and share with us what is in his brain when he guided the FOMC to that decision. Bond market is kind of sad, you know. Debt load are set to expand globally, right? The world, G7, US, Japan, Italy, France, UK, China, only Germany, okay, is bringing down their borrowing, the loans, their debt. So what does it mean? What does it mean, right? In simple terms, supply demand, there's going to be more demand for fund by these global central banks, global government. Interest rate have to go up, right? Basic supply demand problem. Right? And look at this: the diffusion of growing OECD composite leading indicators stand at the top quintile reading of 81%. In other words, global economy OECD is very strong. Right.
Mhm.
So we have a lot of borrowing plus global economy growing very strong. To me, that means higher interest rates. Right? And this is also kind of interesting because it shows that both the 2016 and 2020 election outcomes saw meaningful and lasting treasury sell-off in the subsequent months. Right? So as you mentioned just now, then both the presidential candidate have spoken a lot on a lot of things, except on how to reduce the deficit. Right? Gold. I'm not a great chartist, but I can appreciate how when we break out of the resistance, it ran up, and now we are again breaking out of the resistance. And I thought it's interesting. I thought it's interesting that the gold allocation, right, uh, is extremely low compared to all ETF assets, right? So I'm not a stock market person, right, on ETF and all this, but what it tells me is that in general, the investing public, they're investing in ETF are complacent. They're complacent. They are not hedged against the things that gold is supposed to be a protector of. That is to check against inflation. So this tells me that they are complacent. And what's the pain trade? The pain trade, as we learn, okay, throughout all our years in the market will do whatever it takes to hurt the most number of people, right? And then we have a goal compared to stock market. One would argue from this again that the market is extremely complacent. Right? So all extremely interesting. And it's only now that the ministry is beginning to buy some gold. And judging from what we see here and here, it's not enough. They have barely started, right? So that's all I have this week. Back to you, Dan.
Yeah, okay. Before I turn to Magnificent Seven, I think the investment public still doesn't understand or know how to invest in gold. They have GLD ETF. The S&P 500 has one gold mining name, Newmont. Newmont was up very strong year to date, I think about 45% year to date, but they had a really bad earnings quarter, and I think the stock was down about 15% that day. And they said that their labor costs, their costs were higher than expected, which resulted in the earnings shortfall. And that was kind of a surprise to me because energy prices had come down and many mines rely on diesel fuel to power up their mines. So I thought their costs would be under control, but apparently the labor cost component, which is hitting a lot of sectors, is even a factor in gold mining stocks. So Newmont got hit hard. It's still up here to date, but I think will probably scare a lot of investors away from gold mining stocks because the higher cost inherent in mining. So in any event, maybe the safer play in gold is buying GLD and physical gold. Turning over to the Magnificent Seven names, Tesla had really good earnings, up about 22% for the week, and a little bit choppy for the other names, as I mentioned. It's actually four of the seven names are reporting this week, not five. So we do have Apple, Microsoft, Amazon, and Meta reporting this coming week. So those will be important to watch. Year to date, the Magnificent Seven all solidly in the black, with Tesla being the laggard, but after a very strong week, it's still got a long way to go to catch up to the average of the other Magnificent Seven names. But the momentum is now shifting towards Tesla, we believe. And we'll see how the earnings come out for the other names this week. And I think I mentioned before, NVIDIA, the big one reports after the elections. I think it's November 14th. Next slide, Mike. Turning to the sector performance, the only sector that was up for the week was consumer discretionary. Everything else was down. Worst performing sector was materials, and healthcare and industrials were also down, second and third worst. So pretty lackluster week. We'll see how earnings shake out and macro data impact the various sectors this week. We do expect volatility, and I think a lot of the stock performance will be earnings specific, and outlook guidance will be very important as well. Next slide, Mike. Next slide.
Sorry.
Turning to the economic calendar, I highlighted the ones in my summary at the beginning. Tuesday will be the JOLTS job openings. Next slide, Mike. Wednesday's GDP, 8:30 a.m. Next slide, Mike. Thursday, core PCE, personal income, personal spending, all at 8:30. Next slide, Mike. And Friday, by the most important macro data of the week, non-farm payrolls, unemployment rate, and ISM manufacturing PMI. Next slide, Mike. Here we come to the 168 companies reporting for the week. I'm not going to go through all of them in detail. We'll just leave this up for a couple of seconds for people to see. If anyone would like to get a copy of this, please contact us. There'll be information at the end in terms of, we'll be happy to send you a copy of the deck. Next slide, Mike. This is Tuesday and Wednesday. Next slide, Mike. Thursday is the important day with Microsoft reporting, looking for 311 in earnings for the quarter versus 299 a year ago. Next slide, Mike. Thursday, also an important day with Magnificent Seven names reporting after the close, which is on the next slide, Mike. So we have Apple reporting aftermarket on Thursday and Amazon. I think Meta also reports this week. I think we skipped it in a previous slide. But in any event, Apple and Amazon will be important bellwether names to watch on Thursday after the close. And that brings us to the end of the weekend earnings. For more information, last slide, Mike. For more information or schedule a one-on-one call with us, please contact Cleveland Ashley's number and contact information is listed here. Thank you everyone for tuning in. This was a longer than normal presentation. Just a lot going on, and felt that was important to give some special attention to it. And hopefully everyone is finding this useful. And we look forward to reaching out again next week. Thanks for tuning in. Any closing comments, Mike?
Yeah, just let us know how we can help because we keep on looking at things that the television is not talking about. And meanwhile, enjoy the extra hour because next weekend we're going to switch back to winter time. Okay.
That's right. Take care. See
Bye-bye.
everyone next week. Take care. Bye-bye. Okay.
Okay, we're done. All right.
That's a wrap.